Walmart certainly adding to the positive momentum of today's market rally. The three major averages now trading above the lows from 2 weeks ago as strong retail sales numbers and solid jobless claims data is calming those fears of a recession. Our next guest expects the markets to move sideways from here as weaker data challenges the soft landing scenario. How should you position your portfolio? Let's bring in Michael Kantowitz, Chief Investment Strategist at Piper Sandler. Michael, welcome.
Hey, good afternoon.
Seems like we have some positive data. Not only retail sales, but jobless claims came in at a 1-month low. So 2 weeks ago, we were talking about a potential recession, but that scenario seems to be changing. What do you make of it?
Yeah, well, I think, we have to almost think about the growth. The market's clearly now trading on economic activity and growth data. So let's remember the last 2 years when the markets were really trading on inflation data, and every other CPI print, we'd get volatility in the market and narrative shift. Going from the Fed's going to be cutting 6 times at the beginning of the year to the Fed possibly hiking was the narrative in April. And now we're pricing in another, several cuts this year into next year. And so let's just keep that in the back of our mind as the data now continue to be volatile and create this back and forth between the narrative.
Now we'll look to the next jobs report, right? That's the next piece of data we have before the Fed makes its decision on whether to cut rates in September. How do you think that could influence what we hear from Jerome Powell then?
Yeah, well, the next jobs report obviously is going to be really focused on, there's potential that, we don't see things continue to rise at the same pace in terms of the unemployment rate. But we're going to be looking for clues well before that. We'll get a handful of jobs-related data between now and the next jobs report, between consumer sentiment data, job openings, small business hiring, et cetera. So the data we're focused on are obviously the employment data, but also the housing data. If you think about the economy as a train, housing is the locomotive, the front of the train, and employment is the caboose, the back of the train. So if we're expecting the economy to really pick up here, we'd want to see the housing data really start to improve. Something we often see at the beginning at a soft landing, as soon as interest rates decline. And if we look at mortgage rates, they peaked back in late April. And today we just got the home builder confidence, the NHB index, and that hit the lowest for the level this year. We've seen a big pickup in refi activities, but no pickup in purchase activities, which again is really the driver of the cycle. So I think the picture is still very mixed. And that's going to continue to lead. We're going to get some good data. We're going to get some bad data. And I think market reactions are going to be pretty extreme, as we've seen for the last 2 or 3 weeks.
Michael, a lot of folks lately have started to talk once again about dividend-paying stocks. I'm curious what you think lower interest rates will mean for the appeal, the attraction of the dividend payers. And there are good boy and good girl dividend payers and less good dividend payers. How do you separate the one from the other?
Yeah, we have a model we call the ability to pay model, or ability to sustain those dividends. You want to be careful late cycle, especially when stocks start getting hit under earnings pressure, looking at a dividend yield as being attractive when indeed it's really a reflection of the fundamentals deteriorating, rather than a company that has a good dividend yield that is a function of actually improving free cash flow yield. So we want to be focusing not only on the dividend yield, but also the sustainability of that. We've seen some pretty large dividend cuts this year, Intel being one of the biggest most recently. And so we want to combine dividend yield with free cash flow yield to make sure that companies that are paying dividends will continue to do so. And we're not looking at high yields as a value trap.